Thank you, and welcome, gentlemen. I think it's fair to say that the lunch was very well diversified as well, given how long it took everyone to get back in. I personally diversified on the dessert a lot here. So I don't know how many of you guys enjoyed the jalebis and the gulab jamuns, or rasmalais, I beg your pardon. But yeah, it was nice. But some of these post-lunch sessions can be tricky. So I think the challenge for all of you folks is to make sure that our audience is engaged all through, and I'll try and keep it as lively as possible. But we have a very interesting topic to discuss, so that makes it easier, because the fact is that over the last few years, especially, the investing community in general has sort of tended to either become really specialized or go horizontal, both in terms of asset class diversification from an investment perspective, but also from a strategies perspective. And that's led to, I guess, a deepening of the market, very interesting deals that we're seeing, different structures coming in. And those are some of the things that we look to discuss with the panel this afternoon. We'll also be looking to sort of have a discussion on what it takes to pursue a successful diversification strategy. And how certain firms may well have more to offer relative to others in terms of their capabilities and structures and so on. So here's to a fantastic panel, and I'd like to start maybe with some quick opening remarks from the panelists. And Prashant, if you may start with yourself, sir. Just a quick couple of minutes in terms of opening thoughts, please. Yeah.
So good afternoon, everybody. On the question of diversification for GPs, right, across strategies and asset classes, we are a strong believer in that. And over the years, if you see now, we have 4 different practices, 4 different class of funds with 4 different investing teams doing that. And I think one single biggest reason, if you have to, and there are multiple, of course, reasons, would be the scale and size of opportunity in India. India is a mini continent by itself, right? Right. We have, and the skill set, the teams, and the relationship network and all that you require in each class of strategy is very, very different, right? In the last panel, they were talking about really the distressed assets which are currently being bid, the steel assets and so on and so forth. They're talking about teams, right, etc. Now, those are very different skill set. If you ask a growth equity guy to go anywhere near that, he won't be able to do that, right? The real estate has its own challenges. Infrastructure has its own challenges, right? So each of them, but each today, if you look at it in the country, this wasn't the case 15 years, 20 years back. Each is a sizable opportunity. And I think that is one single biggest reason. And we, as ICICI, being itself a horizontal universal bank, right, have both relationships, skill, and experience across various people, and to be able to do that. I think for a lot of LPs look at that type of on-the-ground experience to really do that. We add that by bringing in partners where we think the right skill set happens. You can bring it at deal level, you can bring it at fund level, right? We have done both things. And I think that offers a true value, right? And that maximize the chances of the money which goes in coming back with good return. The successes are better, right? And that creates wealth for LPs, creates wealth for GP, and of course we do good work in the process.
Thank you, sir. Mohit? Quick introduction to your firm as well, maybe.
Yes.
Yeah.
Thank you. I thought I'll just take this opportunity to tell you a little bit about what we're doing in the infrastructure space. So in infrastructure, one of the learnings that at least we had being in this space for a very long time was that you need to control your own destiny. And by that, what I mean is that we should control the assets that you actually buy and not just do minority investing with a whole bunch of paperwork to kind of protect your rights. So when we started thinking around this theme that, we need to own all our infrastructure assets and solve all the problems as we go forward, we thought that just being a pure, kind of private equity firm, we cannot do that. So we said, let's look for a partnership. And that's how this company called Resurgent Power was born. So Resurgent Power it's a JV between Tata Power and ICICI. And what that does is, Tata Power brings in all the expertise in operations and management and also project management, while all the deal sourcing capability and the deal structuring capability is with ICICI. So we thought this is a really great marriage, and then we put this together, and then we got a few large kind of LPs, kind of pension plans and sovereign wealth funds who have a long horizon. So that's how we put this all, kind of together. And we thought that this is really important because this is an area which is very, very specialized, where you need a strategic partner who can do O&M, and where the skill sets are very, very kind of specific. So what this essentially does is it invests only in the power space, that is thermal power, transmission, and in the hydropower space. So.
Right, sir. Kalpesh, over to you, sir.
Hi, good afternoon, everybody. So, when we think, and what we're discussing today here is alternatives. Alternatives, as I look at it, is not an asset class, right? As a lot of firms in India will mature, we are talking about a business. Alternatives, like any other business that we run. And when you are in business, you need to know what's core to you, what's core capabilities, core skills that this firm stands for, and then see what are adjacencies around those core skills that you can build out. Aeon Capital, which is a strategic partnership between ICICI Venture and Apollo Global, what we find core to Aeon's existence is that we have a deep value focus. And Parth, who was in the panel before, talked about it in the context of distress, but across the businesses that we run, across credit, across buyouts, and across distress, what's core to what Aeon stands for. Once you have that clear, then you can communicate it to your team members, you can communicate to your LPs, and you can communicate the same to the investee companies. And as long as that core is strong, then you can build a superstructure around the core in order to have a well-diversified business in alternatives.
And from a Temasek perspective as well, I mean, you've got both LP and GP activities in your institution.
Yeah.
So how does it work for you?
Just a little word about Temasek. Unlike the rest of the folks here on the dais, one, we are not a fund. Two, we are not affiliated to ICICI Ventures, though we happen to be LPs with the fund. We are actually an investment company owned by the government of Singapore, have been in India for about the last 13 years, have been investing across asset classes, exposure of roughly about $10 billion in India. But in terms of asset diversification, that's absolutely core to our investment philosophy. Clearly, you cannot be investing in India given the market depth that we have here in one asset class alone. I think you would struggle to do that. And you cannot be investing in India solely with one investment strategy either. So as you mentioned earlier, we happen to be both GPs as well as LPs. So we play this, play the investment opportunity in India both directly as well as through funds. Admittedly, our exposure through funds is vastly lower than that of what we do directly. But at least we found that the essence of being able to make profitable investments in India is to have both a confluence of focus as well as diversity.
That's interesting. And, a couple of you sort of spoke about the need for scale, given the complexity and diversity of the market that we're operating in. Number of the LPs, and I think probably CalPERS is one example, they've kind of publicly declared that they intend to reduce the number of GP relationships, but have bigger relationships with the ones. So consolidation, basically, right? Now, the fact also is that this same complexity of India also paradoxically means that you can actually thrive as a specialist firm as well, maybe looking at just one particular sector. So there is a little bit of a sort of paradox there with, diversified firms thriving, but certain sector specialists also sort of going strong. So two questions rolled into one. One is the investment side and the other is the fundraising side. What is the impact if you were to choose to go down the diversified route versus the sort of more specialist route? Maybe Prashant, if you can go back to you and.
Yeah. So I think if you look at investing side, we definitely have synergies that we have seen. We have invested with the same group across from our fund, right? Aon has invested in the same group in a different opportunities where we have invested. That's largely because I think we have large conglomerates in this country. There are large number of businesses that they have. In some there will be stress. In some time the promoter will need at promoter level. Sometimes there are growth ones. Some in there will require VC funding, right? And there will be some infrastructure, right? And things like that. If you look at Avantha, right, where I think Kalpesh did this thing, we did. But they are also having a power side where there is a stress, where Mohit could be talking. And I know there are a couple of things in their portfolio on chemical and other side where I have approached them and said, we want to buy for growth, right? So I think those type of dialogues are much better because both as a house you have ability. And look, I think one of the things we must understand in India, that alternate investing work that we do is not purely transactional. I think there's a lot of relationship angle, right? A lot of things that, do we know them well? Do we do that, right? I think the Avantha deal wouldn't have happened with set of people because if we are coming at the promoter holdco level, right? It's the same in some of the other deals that we do. Because of that reason, the fact that you can do across the spectrum, the fact that you have large, long-standing relationship around that makes a huge difference, right? So asset side, absolutely the case without any.
So just to sum up, what you're saying is because a number of your possible sort of target companies in effect are diversified conglomerates. So there's a better match with Avantha as an example if you yourself in essence are a financial conglomerate or at least an investing conglomerate. That's interesting.
On the other side, on LPs, and you mentioned CalPERS who've articulated this strategy, but all of us who've done the hard yards of fundraising know this. You will have LPs who will say, oh, we are reducing our number of GPs. Euphemism for we are not going to give you any money. So that is a common refrain that you hear, and it's factually correct. And one of the people who voted, who's a key shareholder of Aon's, is the Texas Teachers Retirement System. Texas, I think way back in 2011, was one of the early movers in this space to say, for diversified platforms, we are going to set aside a large sum of money, and $3 billion was the amount that they committed to two firms, $3 billion each. In 2011, one of the firms was Apollo Global, to say across your diversified asset strategies, here's $3 billion, right? Now you allocate, obviously in discussions with us, but that's $3 billion allocation to you. So indeed, you find large, influential investors who have gone down this strategy and not just articulated, actually executed on that plan.
Okay. Promit, if I can get you to put on your LP hat in this context, what's your view?
Yeah, the essence of this, where the LP professed, strategy of LPs is coming from is one must remember that many of the large, LP fund providers globally have their funds increasing continually every year after year. Secondly, you must understand that regardless of how proficient you are, beyond a certain point, it's going to be impossible for them to continually track a very large number of LP relationships, right? GP relationships. And consequently, there will be a point in time when they will say, look, thus far and no more. I'd much rather commit more capital than proliferate the number of GP relationships I have. That holds true for us as well. Our strategy over a period of time has been one in which we'd much prefer to identify very few, but have a long-standing relationship with them. It's also, admittedly a little bit of a lazy thing to do because what that lets you do is you've got, a bunch of people that you're comfortable with, and year in, year out, unless they're kind of doing dramatically different from what you thought they'd do, you kind of double up on what, you're doing with them. So I think it's something that you'll see increasingly more of. Now, that does not, by the way, mean that GPs necessarily are better off diversifying at their end. What LPs are looking at is scale, So, they'd probably say, look, where I could put $50 million to work, I'd prefer to put 100 or 200 or 500 or whatever the number is with one rather than spray it across 10. But frequently, LPs, and particularly ones such as us, are looking for a particular strategy, right, that fits well with our overall diversification theme. So there may be, for instance, let's say a stressed assets piece that fits well with all the other pieces that we're doing, and we'd go out and seek out the people that we think are the most proficient in that and give them capital. We're probably not going to give the capital to a whole bunch of people who are in that stressed asset space. By the same token, we are probably not going to go and give, preferentially give that capital to somebody who's both in stressed assets as well as in growth equity as well as in control, simply because that's something that they do. So one must look at it from the fund provider's perspective. What we do appreciate, and I think Prashant was mentioning, is that there are linkages. For instance, there can be one part of the business which is in stressed assets, which benefits enormously from the fact that there's another part of the business which is doing something akin, and they can, share notes and become much better at stressed assets management than someone else. That we appreciate. But it's not necessarily diversification, much like putting capital to work in companies. You don't necessarily, want a company which is in petrochem and, cars and, whatever, software. You'd probably like someone who's focused. So that's kind of the strategy we have.
You're saying, in a sense, scale is really important. So you're kind of moving the goalposts almost a little bit. But equally where, if I'm interpreting you correctly, it's also about diversification is good as long as there's a sense to it. Bit like the example that Prashant was giving with ICICI Ventures itself. Yeah. Okay, interesting. Any further thoughts on that? Sir?
Yeah, just add to what Pramit was saying. The first thing that our LPs obviously are interested in when they talk to us is our track record and the returns that we've generated for them, right? That is paramount and that goes above everything else. Then when you are dealing with a fund house, and then there are multiple products from the fund house, assuming there is a logic to why these products exist under this one theme. So as long as it's not completely random stuff that you're trying to, put it together. So they want to understand that logic. The other thing which happens with large institutional LPs is beyond, of course, the returns, the next step is predictability, right? There are reputational issues when you are dealing with your GPs. There are actions which your GPs will take, which will show up on the LPs. Pension funds, sovereign wealths, right? People who are very particular about what their money is being used for and in what way does it come home to them. Risk management. When I'm investing in a particular GP, what kind of risk management practices should I expect? What kind of governance practices should I expect? What kind of ESG should I expect, right? Reporting, just simple things like your quarterlies. Is there standardization? What should I expect every quarter to show up? So those kind of things are increasingly more important for large institutional LPs, and that is what a diversified asset management business brings to some of these LPs. Which is, again, I echo Pramit's point that you cannot hence say that niche, specialized, core competence-focused firms have no future. Obviously, they do, and as long as they can operate at scale, they're valuable for such LPs as well.
Sure, and I take that point as well. I think there's enough examples in India as well of very focused funds and firms who are doing really well and making a good name for themselves. So that's wonderful. But at a larger level, I think one of the themes that we've had echo again and again since this morning, including in our early morning breakfast roundtable, is the whole notion of the market itself and the industry itself developing to a point where these conversations of scale hit a different level. In the view of the panel, where do you see, or what do you think needs to happen for us to be able to really get the industry up from the 120,000 crores being deployed today to, let's say, 250,000 crores being deployed, 5 years down the line? Are there any actions in your view that the government could take, or anything that the industry could do to really widen and deepen the pool of capital and the investment opportunities? And in that context, does, again, the question of diversification versus specialized firms, is that a relevant conversation? Prashant? Yeah.
Let me take that. I think if one has to look at one single fact which could do, then probably much more systemic integrity to quick closures, contract enforcements, and things like that, right? I think ease of doing business, even for investing, is really one single way. I think there's a lot more money which can come into India. We can absorb a lot more things which is happening. I think if you look at any side, what you will find is that time to closure, right? And then time to exit because of the huge amount of complication, any disputes to be settled. All of them put a bar around how much and what quantum of risk that you can take, really right there. And when you move very significantly in there, and there are step changes which are happening, right? For example, we are seeing that in some of the infrastructure side, and so you're seeing large amount of money come in the road side because we've really cleaned that up very well. The NCLT is hoping to do that in the distress side, and you are seeing much larger checks than we have ever seen in this space being read. You're seeing a couple of $1 billion being written, right? When we have eased the foreign ownership on the real estate side, we see large amount of commercial assets being aggregated now much more better with REITs and all being opened up. I think so anything which makes it quicker, more certain thing, and taxation is equally a part of it, that will, I think, do it much easier. I think we generally tend to have much more complexity, which is unproductive, right, which is very uniquely Indian, and no one really wants to bang his head trying to understand this uniquely Indian thing to really get the same, outcome with less certainty. That simplification, as and it keeps, and more predictable it becomes. I don't think 10% capital gains is a problem. I think the Mauritian capital gains going away is not a big problem, right? There's an economic cost to it, but a certainty around that dispute being there. What is the problem? You have an exit, and you can't remit money because tax guy says you will give me this thing, and we have that, and we have had that issues. We and ICICI Venture have faced where we had more than $100 million lying with us for more than 4 years because the tax guys kept disputing it, right? Finally, we won the case and it was remitted out. I think those type of things will really probably attract much more money.
So, yeah, please.
I think the other thing, at least we're seeing on the infrastructure space, is more and more we're seeing LPs who like completed assets. They don't want to take greenfield risk. They don't want to get into all this approvals and all the regulatory issues which follow. So they're saying, okay, you show me a completed road, you show me a completed, transmission line, a kind of completed gas pipeline, and I'll buy it. So I think that's what the policymakers are also thinking about at this stage is what are all the assets which have been created in this country which can be sold and which can be a very quick turnaround. This is the point, just what kind of Prashant was saying. So even the strategy that we have for our company is we don't do any greenfield. We buy either operating assets or we buy assets which are very close to completion. Point being exactly the same. We want a quick turnaround and a quick closure of the deal.
So regulatory certainty, degree of transparency, the ability to sort of turn things around quickly. Any further thoughts from this side of the house on this? The whole notion of deepening the markets, kind of getting the industry to grow at a faster clip possibly. Is there, for example, an opportunity to do more efficient discovery of opportunities in more sunrise sectors? Is there opportunity for corporate venturing? So one of the discussions we had this morning, so for example, solar power, right? Or clean energy, we've got some shining success stories. But is there opportunity to do more, even, giving it a push from an investment community perspective and really pushing some of those ventures down a higher growth path here?
So what I would like to add to this point is that we tend to do lots of things. There's lots of press, lots of news around. We're trying to do so many things. And really, we don't need that diverse a menu of options for our global investors. Certainty, as has been mentioned before, and a path to how I can deploy reasonable amounts of money in a reasonable amount of time into this country would be useful. So for example, what takes disproportionate media attention these days are the NCLT cases. And on those NCLT cases, the law was passed in 2016. We are now in 2018. We still don't have a single deal which is done, right? Facts of the case. And you open Economic Times and every morning you will read 2, 3, 4 pages depending on what day of the week you open it on, which will be dedicated to this subject.
Should read VCCircle.
So the point here is that once you are able to show a role model case, I can do 1, I can do 2 large, high quality deals done, then the ability to attract a lot more global capital into that particular space, be it power, be it solar that you're talking about, or renewable in general. Each of those spaces, as you can show, you can demonstrate that as a country we can absorb high quality capital in a reasonable period of time. That I think would be the test, rather than giving this huge diverse menu to say we do this, we do this, we do this, we do all of these things.
Okay. Just want to, I'm conscious sorry,
I think
Prashant.
just one more. And that's something which has now, for the last few years, I think has grown better, but we are nowhere close to where globally is the entire buyout space. I think the segregation of management from ownership, as much more it takes deeper root and as much better availability of leverage and financing around some of these type of stuff. These two things can drive huge amount of capital and asset class. Like if you see any dedicated buyout firms, there are few, right? The deals have improved both in size and number over the year, right? So we're making good progress there. But I think that from what a global scale is, it's still very, very small, right? And I think if we can have that, that would be right, the real big opportunity.
That will be a very cool diversification strategy too, yeah. From it.
Yeah, actually, I just want to say this, that I don't think, we need to do anything to particularly enable the alternative space, to put higher capital to work. I think what we need to do is to enable business to flourish. I think we must be cognizant that, generally speaking, people across the world, India has done a very good job of selling its story. So there is a lot of capital which is waiting to come to India. What you do need is a rules-based system. And once people see that, then people are quite happy and willing to take the risks of investing into India. We've seen that over a period of time, and buyouts is a stellar example. There used to be a time when people would do small buyouts. Now, those sizes of those buyouts have grown by leaps and bounds. The complexity of those buyouts has grown by leaps and bounds. There used to be a time when, I can't think of anyone bidding for a distressed company in India. Today you have very large ones being considered. Hopefully some of them will happen. People, I think we've done a pretty good job of convincing people that there is a lot of opportunity here. But having said that, there's concern about whether, the rules-based system will in effect work or not. And when you do, money will come.
Very interesting. And, as with all these discussions, time flies. So I'm going to get to the last part.
In fact, Resurgent is also on the buyout side. The Resurgent fund that we have with Mohit runs is entirely for buyout, right? So roughly $850 million of capital entirely for buyout to be done over probably 3 or maximum.
Clearly, it's a diversification strategy whose time is coming or has come in your case. Well, all the best with that. Yeah. I just want to move on to sort of, the last chapter of our discussion, which is looking a little bit, through the lens of all of you folks also as managers rather than just investors, because you're all running your own businesses in a sense, right? In the form of funds, and you have teams in there. So a couple of questions there. And again, it goes, just sticking to the overall theme of diversification versus more specialized. From a perspective of talent management and attracting and retaining and growing talent, I would imagine if you're investing across, 4 different classes, multiple sort of teams in place, the complexity of managing talent also is sort of that much more. But at the same time, you have the scale to be able to really attract, the best talent available. What have been your experiences, in the various contexts that you're operating in? Some of you are almost in a startup mode yourself. So there's different experiences there, I suppose. Prashant, could we start with yourself?
Yeah, so couple of points. While the investing pool does not move from one to other because it's specialized in nature, it gives you much more stability if you have a diversified platform, right? Because some of these practices can take time to develop, right? Sometimes even the market to really open up, takes time. I think Kalpesh will narrate for 2 years. They had to keep telling this, story on the distress side and things like that, and how in India you could do mesh stuff and all. It takes a while to really do that. But if you have a running platform which is earning, which has diversity, which has track record, which has relationship, I think you have the ability to do that. It's the same case with Mohit, and the same we have done it on real estate. So I think in that sense, for you to be able to do that and attract talent which knows that you have the ability to go to the distance to really make it happen, dramatically improves. And that the second another thing is, lot of core competence outside of investing in terms of regulatory compliance is the accounting side, the investor relationship side. If you have multiple funds, multiple stuff, I said, the quality of talent that you can attract and retain is far, far higher than someone who's running one fund, which next fund will come after 4 years, 5 years. You do not really get that quality, right? So that's the second big advantage on the thing that you really get. And third thing is, when you have a larger diversified presence, your interaction with the powers that be in regulation, people who are policy forming, both at the government level, Reserve Bank, SEBI, so on and so forth, right, is dramatically distinct. I think for a lot of people who can shape some of that, for example, if you ask us, when we first talked about the stress one, Vishaka and me, we went and met RBI. If you will go back to 2011-12, RBI wouldn't want any private capital to come in stress situation at all, right? So I call it the non-fund-based resolution, right? Like your non-fund-based facility, that was non-fund-based resolution. And one of the points that we made to them, look, you need to get external funds to come for resolution to be really good. And I think they buy that, and I think we said we're going to go on that front. And today, of course, you have so many players coming into that. I think ability to do all that, which is in the cutting edge around from where the country is really moving, the fact that you have more and more play, I think from a talent management viewpoint is fantastic. And I think we definitely think that really does ease up things.
Any other thoughts in the group on this issue? Yes, sir.
So at least in our business, it's all about knowing your ecosystem. So ecosystem is policymakers, regulators, your vendors, your suppliers. And I think being part of an institution, it actually really helps because your access to all these people becomes much simpler, I mean, as compared to somebody if you're just a single fund. So I think we've been able to attract good quality talent, not only because of the deals, but because we're able to give them access to all the people to help us make good quality decisions.
Promit, you've got the sort of the MNC institution kind of ecosystem that you operate in. How does Temasek manage this from a perspective of talent?
I mean, it goes without saying that people are everything. I mean, capital is a commodity, but at the end of the day, being able to make money depends entirely on the quality of your people. And this is where actually diversification is quite important. As an institution, it's something that we found to be entirely beneficial to us. Now, how does that diversification work? To begin with, like I said earlier, we have a very large direct investing platform. The benefit that we have is that that platform has a flexible mandate. So you can invest across asset classes, you can invest across industries, but you can also invest across types of investment strategies. So you can invest in public markets, you can invest in private markets, you can invest in minorities, you can invest in controlled deals. So what we've sought to do over a period of time is to first of all entirely focus our people on industries, right? So they do nothing but follow the same industries day in and out, sometimes for 5 years, sometimes for 10 years, sometimes for more. But we combine that with giving them a pivot, and as diversification, if you will, which enables them to do look at deals depending on where the cycle is or what is of interest. So, for instance, if public markets are doing extremely well, then you pivot towards private transactions because presumably the valuations are more interesting there. When it seems like there are attractive control deals in the market, in that industry, you go and evaluate those transactions. And similarly for minorities, similarly for others. So the idea is that you have to be able to give people a confluence, if you will, of deep industry knowledge and yet, a wide variety of ability, tactics to be able to leverage that knowledge. And, our experience has been, if you have people who are covering an area for the long enough time, then profitability, frankly, just comes. It's almost as simple as that.
Yeah. It's interesting, isn't it? And then I think we coming up to the end of the discussion. I think we've covered quite a distance. I think it's fair to say that the panel probably holds a view that diversification possibly is the way forward. But within a diversified setup, there is room for specialist teams and possibly specialist funds to thrive as well. I think the other important thing which maybe popped out of the discussion really was the importance of scale and the added advantage that scale gives you versus being a relatively small player or a mid-market player. I think there were several examples given there. And I think it was also interesting, possibly from my perspective, to hear about the benefits that you have as an institutional platform rather than just a standalone kind of firm, and how you've sort of at ICICI, for example, leveraged across different capabilities and different sort of assets and teams that you have for the benefit of your investee companies and to grab opportunities which perhaps otherwise you may not have been able to sort of get hold of. And I guess finally, the whole conversation around diversification and scale, I guess, falls flat on its face if you don't have your talent management strategy, right? And again, it helps to be bigger, to be able to attract and retain that talent, both from an investment perspective, but I think equally you mentioned, I beg your pardon, that for some of the other really critical functions which drive success for the fund and the group. So, really, really interesting. We covered a lot of topics. And any closing remarks anyone would like to give? Otherwise, I'd like to possibly close the discussion down and give 1.5 minutes back to the audience here. Any closing remarks from anyone? Okay. In which case, I guess all of you are around. So, if you have any questions, we won't have enough time to, I know the questions will make us overrun. So, but the panelists will be available. Please catch them outside. But please do join me in thanking them for their time and their valuable insights. A big round of applause, please, for all of them. Thank you very much, gentlemen. It was absolute pleasure moderating such a enlightened panel and a great fun as well. So thank you very much.